This is Sarah Schaefer, Business and Crop Online Editor for AgWeb, and I'm here with Bob Utterback, the Farm Journal Economist and President of Utterback Marketing. Bob, you were just on the U.S. Farm Report Marketing Roundtable here at Corn College, and one of the big questions from the attendees is, are we at a new plateau in marketing? What are your thoughts on that?
I think we're in a new price dynamics. You know, we go back to the 80s, it was the $2, $4, and now I would say the new lows as the cost of production is the $3.50 to $4.50 is the new lows. The new highs now obviously are the $8. And the real question we go on and expanded on is we're at profitable levels now. When you look at the price we're producing at, corn last year for 2011, a lot of guys are saying between $4 and $4.50 is their cost. They're getting $6.50. Well, they're getting $8 for old crop corn, but for the corn coming out of the field now here, you're getting in this $6.50 to $7 cash plus. So we're looking at profit margins in excess of $400, depending upon your yield. These profit margins from the last 40 years is at the extreme high. If you look at any USDA data, 175 to 150 over cost has been where we're at. And that's where I think the important distinction comes, is that we are going to go back to that $75 to $100 an acre profit level, I would argue within 2, if not 3 marketing seasons, based upon demand being rationed. There's a conversation come up, livestock producers are not expanding, herd size are going to contract, ethanol is going to be in trouble. Now China's the big bull, and that'll be the bullish side of the equation, but production is going to increase in technology, so eventually supply will catch up with demand, profit margins will shrink, and all of a sudden the malaise of the mid-80s would be predicted. So the question is how big does this bubble last, this sharply higher profitable levels? I think it could be for with the dry weather we got right now, with the anxiety about the August acreage report, the next 2 to 3 weeks could be very turbulent to the upside and a very difficult time for a seller in the market. That's why a put philosophy right now would be better than a short cash or short futures. But in this emotions, just go back and remind yourself, 1988, 1996, 2008, every time 2 weeks before the high, the market was so bullish, everybody thought the market was going to go to the moon. I remember in 2008, everybody thought it was going to go to 10, 12. 2 weeks later, we crashed. That same emotion frothiness, we're in that emotional position right now, and I would challenge you as a seller, start putting yourself in a position so you can take advantage of these profits, and if we go higher, be in position to really start locking that 012 and 0 out markets in a way that you can protect your profit but still participate if the market wants to give you great opportunities.
And another big topic was basis levels. If you're a grain producer versus livestock producers, what's really important for basis levels right now? One
of the things that was really evident last fall through the short crop we produced, is guys that forward cash sold and locked their bases in were extremely penalized versus the guys that put the hedge position on short futures. Even though they had significant margin calls in the futures, the cost of capital being so low that the basis went from an under to a major over now was a very big reward to the forward cash sellers in a short futures instrument. I think that same philosophy will continue. If you're more in the eastern corn belt, I would be strongly urging you not to make a forward cash sale, but do more of a futures, because you're going to have a very strong basis behavior. If you're in Kansas, Missouri, into Texas area, there's going to be an extremely big demand for corn in that area, and basis would be a very big positive. So there's going to be some regionalization, but overall this would be a year I would be more of a future seller, even with the margin call risk exposure, than the cash, because of the basis gain. The other thing that as a futures contract can take advantage of that the cash contract can is the spread relationships. Right now, the September corn, December corn spread since spring was almost 6.55 cents this spring, went clear down to 6 cents a week ago, and is now back in the 20. That movement of that market can have a tremendous impact. So if you sold the Sep versus sold the December, you would have a significant financial gain. I know I'm probably going over ahead of some people here, but this is something you got to start understanding when you're managing your hedge. If you're going to sell some 012 and 013 production, you need to manage the spread, or always be short the month that goes down the most or goes up the least, and that's going to have significant gains to your market. So basis management, spread management, flat price management, and input cost control are going to be the 4 things that you're going to have to manage to be a very effective marketer in the future.
All right, thank you very much, Bob.